Good day, class. Welcome to the last session. In this session, we will briefly look at how to make a financial decision based on financial statements. Let us look at strengths and weaknesses of our own venture, which could be used as guidelines to improve income and reduce costs. The strengths of own venture include human resources, asset values, incoming business, product sales, little debt, good control over bookkeeping, as well as sufficient budget planning. The weaknesses are lack of new businesses, overspending, insolvency, waste of resources, poor control over bookkeeping, as well as insufficient budget planning. Now we will look at some financial ratios which help us determine how profitable a business is, if there is enough money to pay bills, and whether the shareholders should be happy or not. Profit is the difference between turnover and costs. Let us look at a few profitability equations. Gross profit is the profit we earn before subtracting any expenses, such as administration costs and selling costs, which tells us the profit a business makes on its costs of sales. The formula to calculate the gross profit margin is gross profit divided by turnover multiplied by 100. Gross profit is the difference between turnover and cost of sales. The gross margin should be higher than the net profit margin. If a company's raw materials and factory wages increase, then the gross profit margin will decline unless the business increases selling prices simultaneously. Net profit is the profit we earn after subtracting all expenses. The formula to calculate the net profit margin is net profit divided by turnover multiplied by 100. Net profit is the difference between gross profit and expenses. By comparing the gross and net profit margin, a business can get a better understanding of their non-production and non-direct costs like administration, marketing, and finance costs. Let us move on to the rate of return ratios, which are thought to be the most important ratios by some accountants and analysts because they indicate whether the managing director is doing their job properly or not. We will look at two ratios: the return on capital employed and the return on total assets. The formula for return on capital employed is the profit for the year divided by the equity shareholders' funds multiplied by 100, and the formula for the return on total assets is profits before interest and taxation divided by total assets multiplied by 100. Liquidity ratios are used to determine whether the debtor will be able to pay off current debt obligations without having to raise external capital. The current ratio is current assets over current liabilities. In closing, let us look at the relationship between turnover, income, revenue, earnings, and profit. Turnover is the money earned by a business before any deductions for business expenses such as commission fees receivable, insurance proceeds for loss of stock, and other expenses. Income is the money received for normal business activities, which is the same as earnings. Revenue is the amount of money that a company receives from its customers for the sale of products and services. Revenue is less important than profit or income to investors. Profit is a positive return made on an investment. Cash flow is the amount of cash being received and spent by a business during a recorded period or for a specific project. We have come to the end of our unit standard. I hope that everything made sense. If you feel like you've missed something, don't hesitate to go back to your learner guide. Class dismissed.